Question 1 reads, fuel duty is an excise tax imposed on the sale of petrol, included in the price paid by consumers, set at 58 pence per litre. Draw a supply and demand diagram to show the incidence of a specific petrol tax on consumers and producers. So what I'm going to want to do here is I want to draw a demand curve down here and two supply curves. This is going to be just plain S, and this is going to be S with a tax. So we're basically drawing a curve for where we impose the tax. I'm going to come down from the new equilibrium point, come over from the new equilibrium point, and also from where I connect down from the new supply curve. I'm going to draw across to the old equilibrium point. So this is going to be P, and this is going to be PT for P with tax. This here is consumer incidence, this box, and this is producer incidence. So basically what we're saying here is, you might have heard this as the consumer burden or the producer burden. I'm just going to fill in the rest of this. This is going to be QT, Q normal, and this is going to be price and quantity. You want to make sure you're always fully labeling these. But basically what we're showing is who's paying for the tax. Sometimes this is listed as the consumer and producer burden. And what we do is we basically take the full value of the tax, which is going to be basically this gap here that we're adding to the supply curve, is the amount we're applying as a tax. This gap here is the change in price that results from that tax. So we go from the old equilibrium, which is our previous P, up to a new P as a result of the tax being imposed. So for example, if the tax is £10, the price might be going up by £6. The consumer incidence, or the consumer burden, then is that £6 price increase multiplied by the number that we are now producing. So that's this like bottom line here. If I multiply those together and take the area of the square, that's going to be the total amount that consumers are paying of the tax. And then whatever's left over, in this case, we'd say maybe like £4 times the quantity. That's what the producers are spending. So we're basically breaking down the full cost of the tax, some of it going to consumers, some of it going to producers. And basically this ends up depending on what level of price elasticity of demand you have. Because if you have, say, a price elasticity of demand that's really elastic, so a high number, that's going to mean that consumers are likely to stop using the product if you put the price up. So producers tend to avoid putting the price up, and they're going to pay more of the tax burden themselves. Part B says the incidence on the tax fuel is increased in a market in which the price elasticity demand is minus 0.1. Which one of the following is the most likely effect on consumer and producer surplus? And so we've got consumer and producer surplus both decrease, they both increase, and then you've got two options that are basically, one increases, the other decreases. The correct answer for this is going to be A, because if we take a look at our just little diagram down here, if I have a consumer surplus, that's going to be this area above the equilibrium and below the demand curve, and the producer surplus is going to be down here, which is the area above the supply curve and below the equilibrium price. And basically what that's showing is like how good of a deal producers and consumers are getting. So there'll be some producers who are able to make a product for much lower than its market price. They're going to make a big profit. They're going to have a big producer surplus individually, and then you add all of them together, and that's the area of that triangle. The consumer surplus is basically like there'll be some consumers maybe here who are willing to pay a much higher price than the market price, and so they're going to be getting a good deal. And I could measure that down to the price and show, basically how much additional value they're getting. If I were to shift my supply curve to the left by imposing a tax, I'm going to reduce the size of this area. And so I'm going to end up reducing both my producer and my consumer surplus. You can see this area here is basically what I'm missing out on because I'm imposing the tax. Question 2 reads, Question 2 reads, the benefit of higher education include increased tax revenue, faster economic growth, greater innovation, and labor market flexibility. Draw an externalities diagram to show the likely impact of consumption on higher education. So I'm going to want to show just one supply curve, which in this case is actually a cost curve. So this is marginal private cost equals marginal social cost. And that's because we're talking here about differences in benefits and not differences in costs. This curve here is going to be marginal social benefit, and this one here is going to be marginal private benefit. It's going to go down here. Okay, so that's basically showing how much more benefit there is externally beyond the benefits that you're getting for just the consumer of the product. And we can draw here the welfare loss that comes from underconsumption. So this is the cost of more people not going to university. Is like we're missing out on this benefit, which is basically the marginal social benefit, the difference between the marginal social benefit and the private cost that we're paying to produce the product. I could come over here. This is going to be my price socially optimum. And this down here is going to be my price equilibrium. This will be my quantity socially optimum. Sorry, my quantity equilibrium. And this will be my quantity socially optimum. And what this is showing, quantity, and here I'll put cost / benefits. What this is showing is basically the difference between like how many people are actually going to university and how many people ideally we would like. So if we have external benefits, we expect that the equilibrium quantity is going to be lower than the socially optimum quantity. And then question B says, on average in the UK, working age graduate earns approximately 10,000 more per year than a non-graduate. This suggests university provides a substantial external benefit, external cost, private benefit, social cost. So, I mean, this seems good. So it's probably not an external or social cost. While we were just discussing a lot of external benefits, this case, it's the person who is going to university, who's paying for university, potentially, unless their parents are paying, who's going to university and paying for it, who's getting the benefit. So that is a private benefit. This is basically the reason why people go to university, right? So you can think of like external benefits are going to happen to people who are not directly involved in the transaction, so the buyer or the seller, and the private benefits are going to be benefits for the consumer. Okay, so question 3 reads, the EU tradable pollution permit scheme is expected to be more effective by 2020 due to recent reductions in the number of tradable pollution permits. Explain one likely effect of reducing the number of tradable pollution permits. So we're interested in, you could do a range of effects here. We would expect maybe reducing the number will reduce basically it'll increase the cost of the permits, right? It will be like a direct effect. Which we should expect in turn is going to reduce emissions by raising the cost of emitting. Which in turn is going to reduce my negative externality. I'm doing kind of a lot here for a 4 marker, but I just want to make sure I get the points. You're going to be expected to provide sort of knowledge, application, and analysis points for this. So I'm looking for a definition somewhere. In this case, I'm using negative externality, so you could define negative externality. We could even do maybe a diagram, right? So if I did supply and demand, I might show a reduction in the supply leading to the increase in prices. I'm not expecting a complicated diagram for something like this, but like this isn't going to hurt, right? P2, Q1, Q2, right? So this is sort of showing, that took me not very much time at all to draw, but it's helping to illustrate my point. It's going to help you score more points here. You want to make sure you're providing a full explanation to get your analysis points. B says, regulation of firms that pollute is likely to be a problem because A, it allows firms to use price signals, B, it creates unintended consequences, C, it fills information gaps for businesses, and D, it means lower administration costs. So let's sort of go through these one by one. I don't think this is a case where there's maybe a super clear answer. It's more that we're going to be able to exclude the wrong answers. So regulation of firms isn't going to allow firms to use price signals. If anything, it's going to distort price signals, right? So the market is providing price signals. Regulation potentially is distorting those price signals, or at least it's substituting for them. So this is not a problem that it's going to create. Also, that would be like allowing firms to use price signals would be a benefit. So that's also not a problem. Filling information gaps for businesses would also be a benefit, right? It's also unclear if there is an information gap for businesses. Like, people know that pollution is bad. Businesses are aware of how much they pollute. So there's not really an information gap that's being filled. Also, like, this would be a benefit. Lower administration costs, again, would not be a problem. That's a good thing, right? But also, like, regulations generally increase administration costs. So the answer is B, which is a little bit vague, creates unintended consequences. I'm sure it does. But basically, you can exclude the other three, and that's the only one that makes sense in this case. So question 4 says, using the following illustration illustrates the following illustrates the daily average cost curve for a donut producer. Explain what happens to total cost at output levels greater than Z. So what we're looking at is a diagram for average cost. So what this means is basically per unit, we have initially some like increasing returns and then some diminishing returns on whatever our fixed investment is. So basically the reason we have this shape is like, if I'm producing something, I'm going to be limited by some kind of fixed cost in my business. That might be like, I print t-shirts and I have one machine that prints t-shirts. So my fixed cost is that buying that printed t-shirt. As I increase my output, I'm spreading the cost more and more, which is going to decrease my average cost. So if I'm paying £1,000 for the machine and I make one shirt, my cost is going to be £1,000. If I make 2 shirts, now my cost is 500 per shirt. So my average cost falls very quickly. But you're going to hit a point of greatest efficiency, which is here at Z. And after that point, we are going to start to see diminishing returns, meaning if I'm trying to increase my production, it starts to get more expensive. And the reason that happens is if I've got that one machine and like I'm trying to boost production by buying more raw materials and hiring more employees, only so many of those employees can use the machine at the same time. So the more employees I add, yes, I'm adding a bit to my output, but I'm also like, their output is falling, right? So it's getting more and more expensive to add additional output. And so there's going to be this like ideal point here, which is where my average costs are lowest. Explain what happens to total cost outputs at output levels greater than Z. So across all of this output level, my total cost is going to be rising. Total cost will rise throughout. What changes at Z is not whether or not it's rising. That is horrific spelling. What changes is an increase in the rate at which total cost goes up. So effectively, like, you would draw it probably as like it's going to look a bit like that. That makes sense. So as a sort of inflection point here, where like initially we're adding less and less, and then we start adding more and more to total cost. And that's because basically the average cost, the amount I'm adding with each additional unit of output, is going up. 4B says, at output levels greater than Z, which of the following correctly identifies what will happen to the cost? That's average fixed cost. This is average variable cost. So we've actually got a diagram that just shows average cost overall. Our average variable cost is going to be increasing. So we can rule A out. We can't rule B out. Average fixed cost is actually going to be falling over the course of all of our output increases because we're spreading that initial fixed cost further. So actually B is the only answer I can have that's correct, because C and D, just on the basis of average fixed cost, it can't be going up. So B is going to be correct. our average fixed cost is falling over the course of all of our output because we're spreading those costs over more goods. So your average fixed cost is always going down, assuming you don't add any more fixed costs as you increase output. Your variable cost is going to shift, though. Finally, C. Okay, so for luxury donut producer, the average selling price is £2. The average variable cost is 40% of the selling price, and its fixed cost per day is £300. Calculate the total cost per day, assuming it produces 400 donuts a day. Okay, so the average variable cost, and we've got a fixed cost per day. So I'm just taking that 300, right? Because that's fixed regardless of my output. And then I'm going to add to 300 my variable cost, which is 40%. I'm going to do that as 0.40 times the number of donuts that we're producing, the average variable cost and its fixed cost. It's 40% of the selling price. Okay, so this is going to be times 2 times 400. That's a bit weird. Okay, so they're trying to trick you a bit there with 40%. And that is going to give us an answer of 300 plus 320, or 620 pounds. Bit of a weird one, but our fixed cost doesn't depend on our output level, so that's just going to be 300. Weirdly, our variable cost is a percentage of the selling price, so it's going to be 0.4 times 2 times 400, which is the number we're producing. Question 5 reads, Betty's is a luxury cafe, first opened in Harrogate in 1919, specializing in afternoon tea service. Since then, it has produced a further 5 branches in Yorkshire, has no plans to increase the number of cafes. The 6 branches have 2 million customers a year. Explain one reason why this business has remained small. So there's a bunch of reasons you could put in. One, I might offer like avoiding diseconomies of scale. And so you're going to want to just like the link development here, which is our one knowledge, one analysis, is just going to be trying to justify and explain that like coordination across several cafes could be expensive, / consistent branding across cafes could be very expensive. There are other answers you could provide here. So you could say maybe they lacked financing to expand. Maybe the ownership wants to remain in control and not dilute their share, which more financing would require. They might be offering a service that like it would be hard to scale up. Like maybe it's a sort of personal, exclusive, premium service. And if you just open like hundreds of cafes, it doesn't feel like that anymore. It feels like a chain. So maybe they're just trying to protect that brand and they're like less interested in just becoming a gigantic, behemoth. Explain why the previous expansion of this business could be described as organic growth. So we want to define organic growth. Organic growth is growth that is internal. Basically, is internal, reinvesting profits, as opposed to, say, mergers and acquisitions. And you could just say, like, there's very little evidence that they've acquired any other business. Their scale also suggests they've not merged, right? So, like, you can grow organically to sort of 5 stores or 6 stores. That's not difficult. 5C says, assume Betty's merges with a major tea leaf supplier, which I think they have, don't they? Aren't they? Isn't it like Yorkshire Gold or something is tied with Betty's? Which of the following is most likely to be an advantage as a result of this merger? So we have external economies of scale will increase efficiency. So external economies of scale refers to if you're in a growing industry. So like, if you're a tech startup in Silicon Valley, the fact that there's a large tech sector means, for example, you have access to great engineers if you want to hire engineers. External economies of scale doesn't really have any relevance here. This might increase internal economies of scale. Greater control to lower prices of tea, that would be a benefit. C says industrial diversification increases risks. That's not going to be an advantage. Lower monopoly power in the cafe market would not be an advantage, and also like not really relevant here. You're not going to change your level of market control in the tea market, in the sort of cafe market, because you merge with a tea supplier. So B is correct here. Greater control over lower prices of tea. So you'd be able to maybe negotiate better prices. You're cutting out the middleman a bit, so that would be a big benefit.